What we're going to do is we're going to focus on the VIX, and how I want to focus on the VIX and what I want to focus on is really simple. So I'm going to jump right into this. Let's turn off this ticker. And everything that you're going to see on the screen today, just caveat, is from the SIBO. Like this is literally exactly what the SIBO says. So just keep that in mind when we're going through it. All right, this makes sense, right? I mean, simple enough definition. Since VIX reaches its highest level when the stock market is most unsettled, the media tends to refer to the VIX as the fear gauge, in the sense that the VIX is a measurement and sediment of worry. In particular, the description is on the mark. It's pretty accurate, right? It determines what we're seeing out there. So, again, if you want to dive even deeper into this, this is all on the SIBO website. But we're going to stick with the basics and show you how to calculate this. And I'll show you how to calculate it even on like Google. It's simple. Implied volatility typically increases when markets are turbulent or the economy is faltering. Okay, so the volatility spikes when times are bumpy, when the economy seems to be getting weaker, right? Kind of like what we're dealing with right now. If stocks are going higher and there seems like no reason for them not to go higher, the VIX tends to remain towards the lower end, that 10-15% range. So in other words, negatively correlated to stock performance. Usually if the VIX is going up, the stock market's going down. Okay, it's not that hard to understand. If the stock market's going up, the VIX is going down. If the VIX is going up, the stock market's going down. All right, and they give this example. So in 2020, the VIX was at 80, 82, 69 was the high. In the winter of 2013, it was at 12, right? Nothing to worry about. In 2013, 2020, we were concerned about what was going on, obviously, with the pandemic. Now, this is a really simple graph. All right, again, this is all in the SIBO. But what you're focusing on is just the ranges. So you understand when you look at the range and you calculate them out in 5-minute ranges, right? You're just going to calculate them out and say 0 to 15. Okay, 0 to 15 is low. Optimism in the market, things are good. Okay, that's why you'll hear me say I always want to try and buy options when we're between 15 to 20. Options indicate normal market environments, right, around 20. So anything over 20, and you start getting to a position of, hey, there's something going on here. What's going on under the hood, right? And you start looking at it a little closer and going, hey, something's going on here. Something's not right. People use their demarcation line that they use, especially advanced traders, is 20 is the demarcation line. If you're over 20, your antenna's up on the market. It's that simple of a reading. So if the VIX is over 20, you have an issue. Now, you don't know if that issue is going to persist or not, but it definitely means that you need to pay attention to what's going on. 20 to 25, you can see that range. 25 to 30 is high. Indicates turbulent markets. We've seen this, right? Anything over 30 is considered extremely high. I would argue that it's got to be a little higher to be extremely high, but anything over 30 is considered very high. And that means that you could have extreme market turbulence. Well, what does that mean, right? So let's kind of get into that. What it measures. This measures the implied volatility by averaging the weighted price of a wide range of put and call options, meaning we're going to weight the price and the range of put and call options. When investors buy and sell options, the positions they take, either puts or calls, the prices they are willing to pay, and the strike they are willing to choose reflects how much and how quickly they think the underlying index will move. In fact, that's what volatility is. The pace and the amount of change. Okay, so what is volatility? The pace and the amount of change. Okay, so when the VIX is peaking, right, or going up, what we're saying is the pace of what's going on under the hood means that the market could get worse, or that we're going to go through even more volatility. As the volatility increases, that means it could go faster. It also means the range of the speed, right? The range of the speed can go faster. It also means the underlying index, which it measures, which is the S&P, can go and could be variably even more. VIX uses option prices other than stock prices. VIX uses option prices other than stock prices. Why is that important? That's a really important line that we're going to focus on. Why? Because when the VIX collapses, then we know what should come in. Option prices, right? Just because the VIX collapses in the short term doesn't even mean that stock prices are going to come in, but option prices are going to come in. And that's when you can have some fun. We're going to get into that. In this calculation, because the option prices reflect the volatility the buyers and the sellers expect. That's what that's what's implied. Implied volatility means. All right. So keep going. I want to just kind of focus on this so you get an understanding of what this is. If you want to dig deeper into this, just go to SIBO.com and you can get really into this. But I'm going to stick on the tangential parts of it, and then you can drill in more if you like. The option used to calculate the VIX are put and call options on the S&P 500. So the VIX, when you're staring at the VIX, right? When you're looking at the VIX, what you're looking at are put and call options, okay? That's what you're focused on. So I think that's really important for us to take a moment and focus on so that we understand this, okay? So when you're looking at this on the VIX, all right? So when you're looking at the VIX in and of itself, you are focused on one core thing. You are focused on put and call options on the S&P. That's what this is telling you. So let's get rid of this for now. So you can see right here that that's all the calculation. You can see how we try to get below 20. We were unable to, and we know why these lines now are more important, and we know what they've been telegraphing. So, but when you see this, understand what that's actually calculating, because that does make a huge difference. Now, this is what you're measuring, just so you understand that, right? This is what you're measuring. You're measuring 30 days out. So when you look at this, right, and you look at the VIX, it's talking about what's going to happen 30 days out. It's not talking about today. And that's why people utilize it, because of the options they have to buy. That's why when you see this play out, right? So let's take this for example. Okay, you have a high VIX here, right? Hold on, let me flip screens again so you can see what I'm talking about. So you have a high VIX here. Okay? So that means that if you have a high VIX here, then when you get to the S&P, which is here, all right, let's get rid of that because that didn't hold. And you get to here, you have to go out 30 days, right, and say that that VIX is going to affect me 30 days from now. That's how you have to look at it. Not today, but you have to go out there and say, okay, here's, well, it would be 25 candles really. But you have to say the VIX reading now is what this is telling me, okay? It's telling me, right, this far out, okay? You can actually, it's not even 25 candles. It's actually, we can say it's 4 weeks, right? So you could say from there, right? That's roughly what it's telling you, 4 weeks. So you can see where I'm going with that. Hopefully. So that's what it's telling us. This is what the VIX is telling you right now. The VIX is telling you now that we're going to be able to determine the target of, oops, hold on one second. The VIX is going to tell you that we're going to be able to determine the target of the index. Well, how are we going to do that? Well, we're going to get into it. But you can see 30 days out. Okay. So what the VIX tells you about the S&P. So this is a very simple equation, and we're going to walk through it. We're going to do one example here that the SIBO had, and then we're going to do one example of how to calculate where you're at right now. If the VIX is at 10, okay, you take the VIX number and you divide it by the square root of 12. All right, we're going to do this calculation. You take the VIX and you divide it by the square root of 12. All right, that's going to get you a range. If it's 10, that's telling you that within the next 30 days that the stock market will be higher or lower by 2.9%. 15 divided by the square root of 12, 4.3%, plus or minus. Okay, not just the range, plus or minus. Plus 4% or minus 4.3%. 20, same equation, 5.8. 25, same equation, 7.2. Right? Again, up 7% or down 7%. So a range of 14%. Okay. 25, 7.2. 30, 8.7. 35, 10.1. Okay, so what is this telling you? That's telling you that we could have a 20% swing when you're at 35 in the S&P in 30 days. All right, that's why it's important to understand the VIX and what it means. And that's when I say things like, when the VIX starts getting like this, like, well, we're going to have some real opportunity to make money here. This is what I'm focused on. So again, they're going to give us one example, and then we're going to calculate our own example, and I'm going to show you how to do it through Google, so you can do it at any time you want. And it's a very simple equation. It will take you literally less than a minute. To find the volatility, okay, of this is real simple. You're just going to take the current VIX, and in their case, they're using 18, and they're saying we're at 35.50. Okay, we're not, but this is their example. So this presents the following: 18 and 35.50. So this is your equation. Let's get back to it. 18, 35.50. Okay, convert the VIX level to an annual percentage. That's simple enough. Take the number, put a percent in front of it, right? Not too complicated. Divide it by the square root of 12 for the 30-day implied volatility. So you're basically taking the 18 number, and then you're going to divide it not by 12, really important, the square root of 12. And then you're going to say, well, how do I do that? Well, I'm going to show you. It's simple. Then you're going to go and do the calculation. The calculation is simple. Step 3, you take where you're currently at, you multiply it by that number, right, the 5.2%, and it gives you an understanding of where you're at. $186 range, right? 184.6 range. And then you can see step 4, you add it to the top and you add it to the bottom, and you come up with a number. Now, before we go any further, okay, let's do one. Let's actually do this. So let's go to this equation, and let's go to this so that you can see. So now, very simply, the index of the VIX is at 33.4, right? So we can see that we're at 33.4. All right, and we know that the SPY is at 412. So we're going to say 4120. Okay, that's what we're going to just stay with me for the math. We're just going to make it simple. 4120 is what we're going to say, and we're going to say the VIX. And I'll type this all here. Let me just see something. See if they even have this. So they can do it this way. Okay. So there's the actual close. So we're going to use the actual close on this. So we know that the VIX is at, right, 3340. All right. So that's what we know. We know the SPY, or the S&P, is at 41, 31, 93. Okay? So these two things we know to be true, right? 41, 31, 93, 33, 40. Okay? This is what we know to be true. Now, what we have to do is this calculation. So the first thing we do is we take the VIX in step 1. Make sure that I'm showing this correctly. Okay. First thing we do is take the VIX, right, and we convert. Now, by converting this, we just convert it to a percentage, 33.4%. Okay, that's simple enough, right? That was step 1. Now, let's get back to it so that we're on the same page. Step 2, divide the annual percentage, the square root, by 12. Okay, so let's put this up here. Let's put this down here. And let's make this right here. All right, so this is step 1. Step 2 is to divide by the square root of 12. So you can take 33% divided by of 12. All right? And you're going to get a number. Now, how are you going to do this equation? Well, I'm going to show you a really simple way to do this. So this website, is simple, right? This is just Google, right? Google. Type in square root of anything and it'll get you there. Literally anything and it will get you right there. All you're going to do here, okay, is type in the following, right? You're going to type in 33.4, right, divided by, here's a little square root button. I mean, they can't make it any simpler. There's this, that's your square root divided by 12, okay, equals 9.64. Right? So then I'd go to my graph, okay, and that's just Google. Yeah, anybody can do that. All right, let's go back to the graph. So now I have 9.64%. Well, what is that telling me? Well, as we know from this, we know that that's telling you the implied volatility of the index over 30 days. So right now we've calculated what that volatility is going to be. So step 3 is to take this number of where the S&P is, okay, 4131.93, and multiply that by 9.64%. And you're going to get a number. That's going to get you 398.39. So that is the range that you now have. Okay, so if we go back to this equation and we look at it, step 3, let's go back to this and take a look at what we've done so far. So now you can see where we're at. Okay, so the square root, by looking at this, right, we know how to calculate square root. We just simply go to Google. It's simple enough. Then you take that 9.64 and you multiply it by where you're at on the S&P right now, and you get a range. What is this range? It's for the next 30 days. Okay, that's simple enough. Well, what does that tell me? Well, that tells me that within 30 days, that's going to give me my range. Well, let's go out there and just say 20 days, right? Because we know that there's 4 weeks, 5 trading, right? So that gets you the 29th, okay? So we know where we're at in regards to this, right? You know you're at to about May 27th. But let's talk about what this does, this 398.39. That tells you with where the VIX is right now that you could be either right here okay, and now we're going to get rid of this, right? We can see what that number is, right? Remove this, or from here we could be down 398. Okay. Remove this. And now we're going to remove this date because we know where that date is, right? So this is your range and predicted range over the next 30 days, right? You can either rally up, right, to that level, or you can rally down to this level. That's what that VIX is going to tell you. Now, every day that this VIX number drops, these numbers change, okay? So when you have a high VIX, right? So here, let me explain this. So when you have a high VIX, we know the volatility is going to be greater. When you have a lower VIX, we know the volatility is going to be less, okay? And now you know how to calculate that range so you can see it. That's why when I see stuff like this, I get excited because it provides huge opportunity. And it might not be today, but it's definitely down the line. It's definitely coming. So that's what I want to talk about with the VIX before I start getting into options and how you can make money from it. So that took 20 minutes. I thought it'd take, it took 24. I thought it'd take about 20. That's what I have. Now, before I go any further with the VIX, we should understand exactly what the VIX is, how the VIX is calculated. You should be able to understand all of that, and you should be able to do this calculation yourself. I can drop these off, but and go from there. But please ask questions before we go forward, because it's, as I said, this is intermediate to advanced, and it's only about to get more advanced. And I'm going to throw a lot at you in regards to how to sell calls, sell puts, make the right decision on which options to buy. I'm going to talk off the cuff, but it's going to be very specific. So please ask questions if you have them. But I've been asked to do an advanced class for some time, and we'll see how this one goes. So first questions, Brandon. In terms of the move, let's take the 9.6%. Is that peak to trough, or is that from the current level to the upside or downside? It's not peak to trough. It is from the current level, from the upside to the downside. Okay, so, right, it is not peak to trough. It is from the middle range. So in other words, when you look at this, right, you can see that 9.64 can go from 9.64 here to 9.64 here. Okay, that's your range. So this whole thing is your range. That's your range. Okay, this whole thing is the range. So not just this part of it, this whole area is the range. You can either be positive 398, right? Or you could be negative 398. Okay? So, and this is based upon this square root calculation. Now remember, just remember this, because we're going to wind up getting into that in greater detail. Okay, I got to make sense. I'll take it. All right, so now we understand this. All right. Hey, Sue. All right, I just want to make sure that we got it before we go forward. So let's thanks for the thanks for the responses. So I don't feel like I'm in a chat. I'm just by myself. MK Art. Does a drop in the VIX change the option value Greek in real time? Oh, it is very real. They are not. Nothing is locked in when you purchase. They are very real. The options changed drastically on this, and we're about to get into that, and we're going to talk about how you can make money from it. And again, I apologize because this is going to be somewhat advanced. So, feel free to ask me questions. Feel free to ask me questions about this. Look, I don't really get into my background that much, right? But I was a registered options principal for over a decade before I went out and ran my own shop. So I can talk anything about options that you want to talk about. So, but anyway, to focus on that, why I'm saying that is just so you understand, like there's not an option question you can ask me that I probably won't have some kind of answer for, won't be able to pull the right information for you. That said, it's very real, and we're going to get into it. But yeah, it's no joke. So let's get into it and let's have a little fun. And make sure I'm on the right page on the StreamYard app. All right, good. So this is Apple. Okay, and we're going to just focus on this. So I'm going to take Apple and I'm going to give you some examples. Now, why is this important? Well, let's just shrink this down to here for a minute. I want to keep all this up. And you can see the delta, gamma, theta, implied volatility that I have here as well. So what do we know? Well, we know the following, right? We know that the VIX, let's see if it does the VIX here. It might not do the VIX that way. It might do it this way. You're going to give me this VIX M 3-month volatility. I don't know that I want that one. Let's see what that one gives me. Yeah, we'll use that one. So, and I'm going to leave this up for now. But what you're going to see here is you see this, see where you're at right here? Okay, so that's where you're at. You're at 33, right? Now, we know that we're at 33. We know where Apple is. Okay, and what I want to show you is this is the first week, right? So this is the first week of May, the first call, 152. What we're going to look at are a couple things to make the decisions on options. We know that from where the VIX is, and remember while we're doing this, that the VIX is at what? The VIX is at 33. So the implied volatility of this option is 45. Okay? How is implied volatility calculated? Well, it's calculated based upon the put and calls of the entire market is how they calculate implied volatility. Implied volatility is calculated by the puts and calls of the entire market. Well, what determines the puts and calls of the entire market? The VIX. That's why we just spent all that time on it, right? So now that we know that the VIX is the single greatest factor determining the implied volatility calculation, now that we know that the VIX is the single greatest factor in the implied volatility calculation, we know that when the VIX drops, implied volatility will drop. Well, if we know that implied volatility will drop, if the VIX drops, or if the VIX goes higher, we know that implied volatility will go up. Well, then we can make more informed decisions about which options we want to buy and which options we want to sell. Now, one advanced strategy that I do is I sell options, okay? And I will give you an example of this, and then we can kind of go from there. But let's just focus on something like Apple, all right? So if you click on one of these, just to kind of put this in perspective, okay, you will see that over the time, you can see that how this is shaded in, right, over for a course of period. But see how you're drilling down into this and what's happening to that option and how it's imploding as the calls come in? So if we go here and we look at this one, let's take an hourly, okay? So let's take a 15-minute. So here we are with this stock, okay, over the day that we're trading. What happens when it breaks the opening price of that day, the previous day, and how it reacts to that? Well, you can see, and I'll move this down to here, but you can see pretty clearly how the stock dropped. What happened when the stock dropped? This option, 160, okay, collapsed. Well, that's good. Now, what we would want to do if we were going to sell a call, okay, let's say that we wanted to sell a call. Which call would we sell? Well, if we wanted to sell a call, okay, and we think that the reason we would do this, we think it's going to drop, wouldn't we want implied volatility in our favor? And the answer is yes, you do want implied volatility in your favor. So what you would do, or what I would do, is go through my list. And I would go, which one of these for next week, because I want next week, right? Because I want to have the most theta, right? Because I'm selling. Remember what theta is from last week? I said this was going to be advanced, so I'm going to go on the assumption that we remember that theta is time value. And we want to lose the most time value, right? So we don't want to go out this period of time. We don't want to go out this period of time. We don't want to go out 4 weeks to sell calls. We're not going to make as much money, right? If I go out 4 weeks, 3 weeks, you can see, for example, that take the 160s. You can see that the negative 10, right, versus the 160 negative 20. I'm going to lose time value here twice as fast as I'm going to lose time value going out 3 weeks. So since we know that we want to sell the weeklies. We don't want to sell out 3 weeks, even though that those options are more money, right? You know, they're $4 and these are $2, but that's not what we're trying to do. We're trying to make the most amount of money in the shortest period of time. We're trying to make the most amount of money in the shortest period of time when we sell a call or sell a put. So how could we have done this? Or what could we have done? Well, we know our patterns. We know how to trade patterns, right? So we could have looked at this and said, I think that this is done. We could have known that the 50-day, right, is right here, which we know. We can just pull that up. I mean, I can add the plot, I guess, and just put the moving average in there right now and go simple. I think I can do this simple. Just go moving average. Hold on. Moving average, simple, indicator. And we'll just add this one. There you go. No, it's not going to add it. All right, I'm not going to play with that now. I'll get off on the thing. We all know the 50 days right here. So you can see very clearly what happened from that 165 on. Let's go back to the 15-minute. So what was the play? Well, the play was that you could have sold these options for $7, right? Selling something that you don't. Let's move this back down. Let's move this over. And we'll move this down here for a minute. So you could have sold these up here, right? When you just broke down here, used this as your stop, okay? So in other words, you just would have used that as your stop level, 166.20. You would have used this 15-minute as your entry to sell calls naked, right? This would have been your stop. Your range is $1.50, roughly, okay? Your range is $1.50. Well, calculating the delta of that option, right? Now it's 37. At the time, it had to be about 50, probably more than that actually. So we'll say 60, right? We'll just double it just to make the math simple. So we had to realize that $1.50 on that option, right, would have cost us roughly 80 cents. Okay, we could have lost 80 cents at that particular time. What did we sell them for? We sold them for this. We're going to use this line right here. We would have sold them for $6.60. Okay, so if we sold them for $6.60 right here, right, and we just rode them down, okay, and let's just say you rode them down, because once you're up in them, right? So you just leave them alone. Now you can always close them. I mean, that's money management, but I want you to get this concept because I'm going to give you a real life example. So now all of a sudden, what are you doing? You're selling calls up here. You're selling the weeklies because of your time value, right? So we've sold these because of the time value. We sold these because we think that the market's coming in, and we know that buying puts, we're not going to make the same amount of money. How do we know we're not going to make the same amount of money? Well, we know we're not going to make the same amount of money because the implied volatility is too high, right? So we're selling calls instead of just buying puts. Now, I actually do both at the same time. But by doing this, right, and selling 660, we were risking 80 cents. Some people could have just used the high of the option, which would have been 760, which is right around the calculation I just gave you anyway. Breaks down, goes $2. So in this example, okay, you were risking 80 cents and you made, over this course, you made $4, right? So you made 6 to 1 on your money in a day off an option by selling calls and understanding implied volatility, understanding which one of these you wanted to look at because of the implied volatility, right? So that's how you use implied volatility. That's how you use the VIX to make a decision. So that's the first thing I want to cover. And I know that's pretty advanced, but I want to go over it. So before I go on to another example, as I'm going through these examples, please throw out questions on what we're talking about, why this is going on, because I want you to grasp this. So, and I'm going off the cuff because there's a lot of this that I rather talk about it openly than just be formal. So that is how you would make money selling something that you don't own. Understand that the risk is theoretically infinite, meaning you could lose infinite money if you don't cover the option. If you're somebody that has problems honoring your stops, do not do this. Run away from everything that I am saying right now because you'll get annihilated. Okay, you must honor the stops. This is for people that are comfortable with options that are intermediate or advanced. Now I'm going to give you an example of Facebook. Okay, this is a great example. Now, why is this one a good example? Well, let me just go to the calls and the puts. We're not going to go out that far. We're only going to go out 6 days. Why? Because we have some options out there, don't we? We have these 4s. So we're going to talk about these. You can see your percentage changes right here and everything. But let's just talk about what transpired and let's go out there and let's really just focus on this. So what's important about this is the implied volatility of this is in the 60s, right? See the implied volatility of Apple? Okay, 45. Okay, what is the implied volatility of NVIDIA? 89. Okay, this is going to be a very interesting lesson. I might as well just do it now. Which options do you want to sell the most out of? If you had to pick which options you want to sell, which ones would you want to sell the most of, right? Well, let's take a look at how this played out. Okay, here we are at that reversal. We're going to use the same reversal, which is 196, right? 196 would have been this reversal. Okay, so if we go out there and say, well, geez, we would have sold these options. All right, well, which ones would we have sold? Let's go out and say, hold on one second. We'll go out to there, we'll go to the 190. Well, let's keep going. Okay, so what we're going to do is go out there and say, well, geez, would we have sold the 200s? Maybe. Probably would have sold something in here, right? Because you can see how these implied volatility are even greater going up, right? So you can see that and how these options are greater because the implied volatility is greater, okay? So you can see how this actually you could have made even more money selling deep in the money calls. But maybe you don't want to do that because you don't want that risk. So you find like a sweet spot. You look here and go, you know what, I'll sell the 195s. They make the most sense. I really don't want to get hurt that much. Well, you're selling these, right, up here at 11. No, you're selling them here where it broke. So you're selling these at 8 and they go to 4. Okay? You're selling these at 8, okay, and they go to 4. Well, why did this have a downward move like it had, right? Because you had a decent move down, very similar to what you had in Apple, right? But Apple was down a little more from the high, right? From that move on that percentage basis, but pretty much the same exact thing, right? Looking in the mirror. But we only would have made a double on these options. Well, why did we only make a double on these options? Okay, so if you're in a rising VIX environment, which options do you want to sell? Right? If you're in a rising rate environment and you go out there and you look at these, let's just do it again. Okay? And I'm selling these at 6 and they're at 250, right? 6.5, but they're at 250. I made a triple. Same exact move down, right? Same exact move down, roughly. I mean, we can do the percentages if you really want to, and I made triple. Versus if I did the option that we just talked about here, right? How did we do? Okay. Well, we basically made a double. Why? Because the implied volatility is going to keep this option afloat in a rising VIX environment. So the implied volatility is going to keep this option high in a rising VIX environment. Okay. The implied volatility is double here as it is in Apple, right? So you can see that, right? Just very simply, just put implied volatility, there's your number, and you can see that. Well, that's interesting. How can I benefit from that, right? How could you benefit from a rising rate environment? Well, buy options that have low volatility. Now, what happens and what environment should you be in if the VIX is going to implode? Let's say that we're looking at the VIX and we say, wow, this VIX, it's really going to come in. Okay, things are better. Powell got it together. They come out with a plan. Everything's rosy. There's no war. Everything works out great, right? VIX is imploding. Which options are you going to want to sell? Okay, in a falling VIX environment, you do not want to sell the calls on Apple. You're going to want to go out there and find something that has huge implied volatility, like this, okay, LABU, right? And go, wow, look at this implied volatility. So if I sell the calls or the puts, like I think it's going to go higher because we're imploding. So I'm going to go out there and sell the puts. And I go out there and sell the 8 puts that at 174, right? Because the implied volatility is going to get shattered, okay? And that's how you can make money selling puts in a falling rate environment. If you're in a rising rate environment, or a rising VIX environment, you need to look at your implied volatility and understand that. And this, I was asked about this over and over again. Should I be buying leaps on this stock? And the reason that I kept saying repeatedly to the people that kept asking about it was, no, this is not the time to be going out there and buying leaps. And here's why. See this implied volatility? This is going to get slaughtered and cut in half. So this thing's going to bounce 20%, right? And you're going to make 0 because the implied volatility is going to get cut in half. All right? So I threw a lot at you. I definitely want to do one example of a trade that we actually did and how you could have done this a little differently. And I'm very apprehensive to put these strategies out there in the option alert room because you can get annihilated. You can get hurt really bad doing this if you don't honor your process. but I wanted to teach like one advanced strategy. And then if we like these advanced strategies, I can do a class all the time on them. I mean, we could do one a month on different strategies, iron condors, long straddles, short straddles. I mean, I can do them if there's an interest, but they're advanced, and you need to honor your process. And when you're wrong, you're wrong. You just move on. So if we take a look at let's go out to here. Let's bring this all back to 6. And if there's questions in the room, I will answer them in one moment, but I really want to get this out. So here you are, and these are the ones that we own. Now, they did an excellent job on me on Friday. Okay? They got me the higher high. They got me over. Okay? They got me over my line. Completely convinced me at one point that, hey, I need to hedge, so I bought stock. That didn't really work. I wound up blowing out the stock when this happened here. Okay? But by that time, I already started scaling out of the puts, right? Now, what was the move? Well, we put the puts back on, but we didn't make any real money on the puts. The other thing that you can do, right? And I do this. So I want to be very clear. I do this. You see where you're at, like 210 up here? So I will go out there, and let's just say that I bought 10 puts, okay? I will go out there and sell 5 calls, all right? So I'll take half of whatever I bought in puts, and I will sell calls against the position up here. So what does that do? Well, in this scenario, here are these puts, right? And these are the ones that we're in, okay? So I go out there and I can sell the 210s, right? I can sell the 205s. Now, which ones would make the most sense? The ones with the least volatility. But if you go out there and go, you know what, I'm going to sell the 210s because I want to see if we're going to get over that line or not. So let's say I sold the 210s, all right? And you can see where you're at. You're at 575. Now, during that period of time, right, where those options are, they collapse down to here. And by the end of the day, you're down to here, 240. So off of those options, I bring in another, let's just say that I get slippage, right? And I get off here. So I make another $3 or 100% on that 50%, right? Well, what does that do for the calls that or the puts that I put back on that we're up now? We're up 100% on those puts, but we lost money on the other ones. So I mean, it's basically a wash on the trade, unless you doubled the position. But that's another story for another time. But you see what I'm getting at here? So yeah, I made 100% here, but those options cost me $2. Well, I just paid for half those options by selling these calls against it. So in other words, I'm allowing the move to pay for my option position, right? I'm reducing my cost on my option position by 50% by selling calls with the puts that I buy, okay? Again, if you're wrong, you need to close the whole thing out immediately because it can get bad. But this is a great way to do money management, okay, and have the market actually pay for your positions. So I really wanted to go over that so you get it, because I do that a lot. And if I'm wrong, I just close it. I just take the loss. But with the VIX where it is and what's going on, sometimes these options don't even move that much, right? They'll hardly move because the VIX is high, so the option doesn't really go against me that often, right? So, I mean, even if you look at this, if you bought here, right? I mean, if you bought here, even if you bought at the close here on this option, okay, 585, and this is the close, when you went from 208 to what is the high of this? 211, 212 and a half. So you moved $4 on this option, okay? And it closed at what? So you would have made $1, okay, on a $4 move on an in-the-money option. So that's how little these move when the implied volatility is up. So it makes sense to do this when that's going on. So I know I threw a lot at you today, and I know it was intense. So if you have questions, I'm here to answer them. So let's get into it, because I got questions. How did you calculate the risk using delta? Well, you just go through the delta and look at the position, right? So you just calculate the risk using delta. So in other words, Kobe, all you do is go, hold on. Let me get, which thing am I in? I get confused. All right. So what you can do, will this maximize it? No, let's just do it this way. Come on. Boop, 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 boop. Nope, you won't make it bigger. No, maybe this will make it bigger. Or hopefully this won't do something weird to the screen. Nope, that didn't work either. Wish that would blow up somehow. Got to be a way to do that. Anyway, so here's what you do. You look at the delta right here. Okay, so if you have this option, let's just take the stocks at 200, right? It's not, it's 201, but okay, so here's your delta, 53. So if I own 10 of these calls, my delta is 53. I own 530 shares, meaning the stock will move that amount. Delta is how you calculate the amount of shares of risk outstanding, right? So that's what I would be long. Similar, if I had sold the 200s, right? If I'd sold the 200 puts, okay, then you have a negative 47, but I sold them, so I'd be long 470 shares, meaning that my options, those 10 options, would move like 470 shares of stock. So hopefully that answers it. If not, let me know. In a rising environment, you would be selling puts. So in a rising, that's entirely up to you and what you think is going to happen with that position. Okay? So if you're in a rising environment, so to answer this, if you're in a rising environment, here, let's shrink this down. All right, we're going to just shrink this and put this down here for a moment. So let's just say you're in a rising VIX environment. All right, and I forget which one to use. Let's just use this 3-month, I guess. All right, so here's the 3-month, and let's go out here for a day. So I'm in a rising rate environment. Well, what happens during a rising VIX environment? I'm sorry, a rising VIX environment. What happens during a rising VIX environment? The S&P goes down, right? Okay, so if the S&P goes down in a rising VIX environment, do I really want to be selling puts? Probably not, right? You probably want to be really careful because of that. Now, if it's something that you want to own for a long period of time, Storm, yeah, you can sell puts. Let's say that you want to own, I don't know, let's say you really want to own Apple. You really want to own Apple, okay? So you could go out there on Apple, but this, I wouldn't even do weeklies with this. But let's say you really want to own Apple, and let's get the puts out there. Let's just do puts only and answer this. And I'll stay a little bit longer. I know this is advanced, but that was what I was trying to do because I've been getting a lot of requests for advanced. So, but here's where you're at. Okay, so 160, and you can see the levels, right? You can see where you're at here. So let's just click on this. So here you are, 160. So let's say that you really want to own Apple, okay? You can sell the 160 calls. Sure. If you sell the 160 calls for next week, you're taking in roughly $5. You're taking $5. Your cost is $155 stock. So the question you have to ask yourself is, by the end of next week, are you willing to own the stock at $155? If the answer is yes, then do it. I mean, that's not really what my kind of trade, but you can do that, sure. I mean, I would be really careful with what I'm explaining to try to be picking up pennies in front of steamrollers, right? That's not what we're trying to do here. So in other words, you could go out there and say, I'm going to sell the 150s for $1 because we're not going to get there. Well, what happens if the stock goes to 145? Think it can't happen? That would be pretty much a very similar drop to what happened today. You don't think it can happen in 5 days with the Fed meeting? Right? So I'm out there trying to pick up $1.30, and the stock's down $5. Well, now it just cost me $4. So do I want to do that? You know, I was doing this with T-Doc all day long the other day, just screwing around, selling calls against it, and then it went against me. Right? Now I have to make a decision. Do I want to own? I was selling calls. Now, do I want to own T-Doc? No, I don't want to own T-Doc. Right? So now I'm like, oh, I got to go close these. Right? So, but, you know, on something like this, I think I was selling these for like $1, and then they went to $2. I'm like, okay, I'm out. I'm done. You took out the higher high. You got my money. right? But that's selling calls against them. Okay, you can see how the calls imploded from here, right? If you did it off the open, which is really the move. If you ever have bad earnings, I'm going to throw this. I know I'm throwing a lot out there, but this is really, you can do very well with this. If you ever have bad earnings on a stock and you think it's going down, this is the perfect strategy. Because look at this. Here's your call, or hold on, let me find them this way. Let me find the calls, looking at the puts. So let's go to these. So see this? You wait for this thing to go up and then it collapses. I mean, off a simple 35 weekly option, you're cut in half. And the stock, like just here, let me just show you this. Okay. All we're doing is looking at this day, right? You can come back and look at this day too. Okay, you can look at them. But if you're looking at this day and you're like, I really think that this is going to implode. See that move? Look at that. If you were selling those calls, you have a double. Right? And the stock didn't even move, right? Like, you see what I'm getting at? Like, look at this. You're from here, right? So that's here. Let's just mark it off so you can get this. So from here, you're at 34.77. You closed here, 33.90. So during that period of time, the option went from, let's get the low of that option. So we got the low of the option, which would have been 220. And say that you went to here, right, 139. So you have 100% gain on a 30-cent move, okay, by doing that trade, the way I just walked you through it. 100% gain. And it would have been more if the implied volatility wasn't so high. But in regards to selling puts, I went off on a little bit of a tangent there. You'd have to pick the stock and make a decision if you really are willing to do that. And you're going to either own stock or you're going to write a check. One or the other, right? So you kind of have to look at that and go, do I really want to sell these for, do I think that I'm not getting the 180 on these? Do I think I want to sell these, right? And this is another great example. Look at where we opened, right? $3, and now you're at 5 3/4, but you hardly made money, right, for the move, right? I mean, you called like if you shorted this, if you bought these puts, right, off the open, if you bought these puts off the open, 3 to 5, right, off of that move, and that's because the implied volatility is so high. But can you sell them? You can. Just be prepared to own the stock. I wouldn't do it in a rising environment. I would do it in a falling environment. That's when I would sell puts. That's when I sell puts. I hope that's helpful. If you think this, wait for the VIX to implode. As soon as you see the VIX imploding storm, boom, you're selling puts. You're finding names, you're selling puts, right? You're not selling calls. You can, but you really don't want to because stocks could rally, right? The VIX is telling you how much stocks can rally, right? Remember that calculation we did over here? Hold on. So it's telling you that you can rally, right? So remember this calculation? So let me just get back to that page so we can talk about this. So you remember this calculation? That's our range. So what can NVIDIA and Apple do in a range like this? Okay? This is what we're setting up for. A massive move one way or another. Right? Either way, we're going to profit from it. So, but this is what you need to focus on. Right? This is your range. So if that's your range, you want to be careful selling calls into it. But selling puts, yeah, it makes a lot of sense. Makes a lot of sense. So in a rising environment, you're selling calls. In a falling environment, to me, you're selling puts. Yep, you got it. All right, could you look at this for Facebook? Did you sell calls? Puts? Yes, I did. Yes, I did do that. I sold calls. I do it all the time, and I usually do a 2-to-1 ratio. So let's just say that I'm long 10 puts. I'll sell 5 calls. I do it all the time, especially in high vol areas. No, it's not the sum that you invested. No, it's not the sum you invested. And that's why YouTube, before you even think of doing this, you really need to calculate the risk. So it's definitely not that number. It's definitely infinite. Your loss could be infinite. You could be writing a check to your brokerage house. So it's one of the reasons why I was really apprehensive to even go over this. But let's just focus on this because that's a really important U2. So let's just take NVIDIA. And let's say that you want to implement this strategy. And so you buy NVIDIA, you sell NVIDIA calls here. Okay? You sell them at 202, or let's just say you sell them here. All right? And you sell calls at 180. Okay? So you sell, hold on one second, I'm sorry. I apologize. So let's say you listen to my idea and you're like, this sounds great. I'm going to do it. And you're at 186 and you sell the 190 calls for $6. Okay? And let's just say that the stock goes back to 227, right? In a week, which can happen next week, right? We could move this amount. See the implied volatility? See that equation I did with the VIX? Okay? You can do a similar equation with this, and I'll give you a range. All right? That's a class for another time because the equation's a little different, but same back of the envelope, it'll give you a range. So, if you're looking at this, then you can get to here. Well, that $5 could be $30, $40, $50 by the time you're here, right? I mean, on this move, just so we're clear, on this move, right, from if I got back to here and I sold here, right, that's 40 points. So if I sold for 6, I could be adding 35 to it. If I'm adding 35, that means for every $600 I just tried to make, I just lost 3,500. Okay, so your losses can be infinite. And that's only assuming it stops there. And then you go, oh, I'll just wait for it to come back. Well, now you're here, right? I mean, theoretically, it could be infinite. So you need to really understand that. You can lose everything doing this. So you have to have a strategy and you have to implement that strategy, right? You cannot play with it. There's no like second guessing. Yes, you're naked. Exactly, Dimitri. It's naked. How do you get the charts at the bottom where you have the call graphs? I am using, in this example, I'm using TC 2000. So if you have questions, throw them out there, please. I know this is a lot. You know, I probably could have brought this into different levels, but please throw them out there. I'll stay a little bit longer if you have questions. How do you get the charts at the bottom where you have the call graphs? That's TC 2000. It's another one of the programs I have. I just thought it was very easy to use this one. I'm using something else because I can pull these graphs up and I can click right on these and it'll show me everything I want pretty cleanly. Right? You see how it just moves around. It's a really cool project. So I like this system. I don't use it that often during the trading day for whatever reason, but it's really good. It's actually really, really good. It's very easy to like click on things and, you know, plot drawings, look at an option trade, create a price alert on an exact number, just hit a button. What do you want to do on a 1 minute chart, right? When do you want it triggered? Do you want it every minute, right? How long do you want to monitor it for, right? And it actually will beep, go to my phone. So every once in a while in the background, you'll hear like a gong. That's when stocks are hitting certain levels. So, and you can do it with anything. You put the VWAP on there. Like this was the easiest trade in the world. And, you know, and here, look at this. Like if you looked at this trade on VWAP, like that was the easiest thing in the world. Hold on. Let me show you this on another thing. Because I know, again, I'm going off on a tangent, but I have so much. I was looking at the classes I want to teach. And there's so much I want to teach. But like VWAP trades, we should really talk about this. And this would be a great time to talk about it, actually. I'm not going to get too into it, but I'll show you on this how to do this. So you see this, right? So let's just use and these charts are working 1-2 minute charts. They're working like clockwork. But so let's close this up. Let's pull this down. So this gave you 2 real entries after the day. See how it got up to here? Rejection, right? So if you were using this, okay, you would know that institutions are selling, right? You got up here, you can't power through. Got up here, can't power through. If you want to go look at something, go look at if you sold calls on Amazon every single, you know, either one of these times for the day and what you would have made, right? It's crazy. Okay, so it's really crazy here. Like, hold on one second. Let me flip this to you so you can see what I'm talking about. So I'll show you on this. But you see these levels right here? Just go and take a look at what happened if you sold calls on these right here. Right? Bought puts as well, but if you sold the calls, I mean, it was just a killing. Hold on one second now. You see that, right? So if we go to, let's go back to this now. I know this was a lot today. I could have broken this up. The more I'm going over it, I could have broken this up into several different lessons. Let's make a minute chart. And let's get this out of the way. And let's, poop. Why you give me that? That's not what I want. I don't want to add the plot. Let's go here and go 5 minutes. Maybe you'll make it better. Yeah, you'll make it better. So if you look at this, this doesn't have that functionality that I want. If you look at this from here, and let me just give you an option so I can do this and move on. We'll just say 25, 30s. I don't think it really matters. Well, let's just keep going up until we get to 50s, because you would have done the 50s, right? So if you look at these options and you look at them here, and let's blow this way up. I wish that would be better. Maybe this is why I don't use this software too much. I don't like how small this is. But if you use that level where I'm at, that I'm talking about, these were at $70, right? And then just look at how they imploded by the end of the day. At the low, they were at 25. You're up 300% on like a 2.5% move. So, but you just have to be fast, because if you're wrong, you're wrong. But you would have cleaned up on those just by doing a simple VWAP trade. So there's definitely money to be made there. But all right, let's keep going through the questions. I have January 23rd, Covani puts have been riding 150. What am I supposed to do? You have to watch the IV on those. Yeah, I think you're going to clean up on those. I mean, a lot of people don't understand that the deal with Apollo was a really bad deal. And they don't really understand that yet. Apollo wants to control the company. So what Apollo is going to do is Apollo is going to put him in a death spiral, right? I haven't read all the terms yet. I guarantee Apollo has prepayment penalties, issuance or first rate of preferred shares. They'll have all kinds of stuff that can cause a death spiral. So I think that they're going to try to drive it down, and they need to do it because they need the money. But yeah, you need to watch that. And I think that you could absolutely clean up on those. I really do. I think that this is going to be, you have to realize, look, you have to keep powder dry. So like, I don't know how many of those you have, and it's none of my business, but you have to keep powder dry so when this happens, you can take advantage of it. Okay? I mean, you can see this on Carvania, hopefully. Let me just, hold on one second. Let me switch the screen so we can talk about your particular option. All right? But if you can see this here, right? But yeah, but your implied volatility, I mean, you have to understand that, like, you need to watch the implied vol, because when your VIX drops, right? When the VIX drops, and this will drop, the question is just where, right? You don't know if it's going to get to 50 before it gets to 20. No, nobody knows that. Can it get to 50? Yeah. Yeah, it can. Yeah. So, yeah, it can. So just kind of keep that in mind. But yeah, you have to keep your eye on this, and you have to keep your eye on the volatility. So just something to think about. You absolutely have to do that. Let me just see what else I have here. If that starts dropping to the closing, yes. If that starts dropping, if the VIX starts dropping, okay, then most likely Carvania will go flat, and those options will lose value. So if you start seeing the VIX, you know, and you think there's a bottom in the market, then you probably want to close those. Yes. After earnings are released, does the right at the open? So Dimitri's question is a really good question. After earnings are released, does IV implode right at the open, or does it take some time during the day? Right at the open. They just suck the living premium out of everything, right? And just crush people. All right? So it's right at the open. Now, you might get some blips while they're adjusting, but the real money that these guys make, the option traders, like the real option traders, not the lotto stuff you see, posted, real option traders, what they do, right, is they sell those options. They might sell both sides of those options, right? They might sell the calls and the puts. They don't care because they'll just have their strategy and then they'll cover whichever one doesn't work and leave the other on, right? And if they make 10% on the whole position for the day, what do they care? So, but yes. Let's say you sold the 150 puts and didn't protect myself by doing a spread. How does rolling these out and and does rolling these puts help weight out? It doesn't really help you. It's like, let's say you sold the 150 puts and you didn't protect yourself, right? Rolling them out, all you're doing, it's like you're plugging, you have a bad trade and you're trying to figure out how to make it a good trade. Well, you're not going to make it a good trade, right? It's like, I don't know. I was going to equate it to something else, but I won't. But it's like, let's say you have a dam, okay? And there's this water behind it. And the water behind the dam is losses. And you keep poking your finger in there. Well, what happens, Dimitri, when you roll it out a month and Apple goes to 140? You roll it out another month and now you're at 130. Well, now you're a long-term shareholder for the next 10 years in Apple. So now, cut it, move on. What you can do, if you sold puts, right, and the stock's going down and you're trying to hedge yourself, you can take the other side of the trade and you can sell calls and book some premium that way, right, and lock in the loss and then reevaluate it. Because if you let's say you sold puts, right, and I'm more than happy to get this advanced right now. Let's say you sold puts, but you think the stock's going to go flat, right, but you're like, I got to protect myself. Well, when you sell puts, right, you're buying delta. When you sell calls, you're selling delta. So you could delta neutral the position and just let implied volatility, right, and time come in, okay, and then just book that off the trade. So you can do that. That is possible. That is one thing that you could consider doing. I can do a whole class on that. Yeah, MK, this is advanced. That's why I was very apprehensive. But some people we have the gambit in there. There's people in the room that manage a lot of money, that are they manage a lot of money. And then we have people that are paper trading and learning. So I was apprehensive to do this, but I've been asked to do it for a while. So I wanted to give this level. And then if there's an interest, then I can drill down more into it. The purpose of this, and I do think that everyone should listen to this, whether or not they're beginners or not, because I really want people to get out of the mindset of, quote, lotto options and this and that, and understand that, there's this thing that I'm really starting to try to rail against of the big traders stay out of the market when, times are tough. No, they don't. They don't. I know a lot of people that trade for a living, and they're not out of the market. They're trading. If you think that the big hedge funds right now and those traders in those desks are not trading because they have, quote, stay out power, they're making killings, right? Because of the volatility. They're crushing it. That's what you have to understand. It doesn't matter if the market goes down, the market goes up, the market goes sideways. There's always a way to make money. And it's your job to look at all these skill sets as a tool and put this tool in your toolbox and then break it out. Sometimes you need a hammer. Sometimes you need a screwdriver. Sometimes you got to find that funky Allen wrench, right? But they're all tools and they all go in the toolbox and then you pull them out. That's what I'm trying to get people to do, MK. So I hope that helps. But, focus on it and do it or don't do it. But at least you can understand it now when you look at implied vol or the VIX, And if you got nothing out of it today, you now know how to calculate the VIX, which puts you above 90% of all traders. If and when you decide to sell a weekly option, would you say it's better to do it on Friday before the week of expiration or Monday expiration? Does it really depend on your pick and spot? I like selling on Friday. I'm not saying it makes any sense. I'm not saying it makes any sense whatsoever, but I like selling on Friday. And the reason is because the people that bought the option on Friday usually don't have it go the way that they think it's going to go. So then they sell. And when they sell, it adds to my value. But as far as time value decay, implied vol, it doesn't matter because it's the weekend. But I do it on Friday, Storm. Yeah, absolutely. Keep asking. Keep asking questions, It was a really good question. So, all right, I'm going to wrap it up. But think about it, Utu, and think about it like that. It's a tool that goes in the toolbox. Sometimes you need that funky tool. Sometimes you don't, right? You don't do this when the VIX is at 15. You'll get killed.